Before investing in any mutual fund or ETF, one of the most important yet most overlooked tools is the fund fact sheet. It might look like a boring PDF filled with numbers, but inside, it contains all the essential information you need to make a smart investing decision. Think of it like the nutrition label on packaged food. Just as you wouldn't blindly eat something without checking its ingredients, you shouldn't invest your money without understanding what's inside the fund. A fact sheet gives you a snapshot of the fund's objective, holdings, costs, risk level, performance, and much more. The problem is, most people either skip it or don't know what to look for. That's exactly what we're going to change in this video. You'll learn how to break down each section of a fact sheet, line by line, so you never have to rely on blind trust or marketing claims again. Let's start with the basics. A fact sheet is a 1 to 2 page document released by fund managers or companies that outlines key details about a mutual fund or ETF. It's typically updated monthly or quarterly and gives you a performance summary, the fund's investment strategy, top holdings, risk statistics, and charges. If you're investing in an ETF, this will often be called a fund overview or fund profile. The structure may vary slightly between companies, but the core elements are always the same. The goal is to give both new and existing investors a quick, clear picture of what the fund does and whether it matches your financial goals. And here's a tip. Always download the latest fact sheet directly from the fund company's official website, not from a random blog or forum. That way you avoid outdated or manipulated data. Now let's go through the fact sheet, starting with the fund objective. This is usually the first thing mentioned at the top of the page, and it's your North Star. The objective tells you what the fund is trying to achieve. For example, it may say, the fund seeks long-term capital appreciation by investing primarily in U.S. technology stocks. Or it might say, the fund aims to provide consistent income by investing in high-quality corporate bonds. By reading this, you immediately understand two things: what the fund wants to achieve and how it plans to get there. If your goal is long-term growth, a fund focused on income might not be the right fit. Beneath the objective, you'll often see a brief investment strategy. This explains how the fund manager selects stocks or bonds. For instance, they might use a growth strategy, value investing, or a passive index tracking approach. If you don't understand the fund's objective or strategy, it's a red flag. You should never invest in something you don't fully grasp. Next comes one of the most important numbers on the fact sheet, the expense ratio. This is the annual fee the fund charges you as a percentage of your investment. For example, if the fund has an expense ratio of 0.75% and you invest $10,000, you're paying $75 per year in fees, whether the fund performs well or not. Now, this may not sound like a lot, but over time it adds up, especially if you're investing for 10 or 20 years. High fees can quietly eat away at your returns like termites in a wooden house. In general, passive index funds and ETFs tend to have lower expense ratios, often below 0.2%, while actively managed funds can charge over 1%. You're not just looking at the raw percentage, though. You need to compare the expense ratio to similar funds. If two funds offer similar returns and risk, but one charges half the fees, the choice is obvious. A good rule of thumb: always ask, is the fund giving me value for the cost I'm paying? Now let's move to performance, the section that usually gets the most attention, but is often misunderstood. Most fact sheets show the fund's past returns over 1 year, 3 years, 5 years, and since inception. You'll see these compared against a benchmark, which is the standard the fund is trying to beat. For example, a U.S. large-cap equity fund might use the S&P 500 as its benchmark. If the fund returned 9% last year and the benchmark returned 7%, it means the fund outperformed. If it returned only 5%, it underperformed. But here's the catch. Never judge a fund just by its recent performance. One good year doesn't mean it will keep winning. What you really want is consistency over multiple time frames. Also, check how the fund did during market downturns. Did it lose significantly more than the benchmark? Or did it protect capital better? And finally, compare annualized returns, not just cumulative ones. Annualized returns show the average yearly return, which gives a clearer picture of long-term growth. But looking at returns alone is never enough. To truly understand what you're investing in, you need to go deeper into the actual holdings inside the fund, the risk measures, and who's managing your money. That's where the next layers of the fact sheet come in, and that's exactly where we're headed next. When evaluating a mutual fund, one of the most overlooked yet crucial sections on the fact sheet is the risk metrics. It's not enough to know how much a fund has returned. You must also understand the volatility and stability of those returns. Let's begin with standard deviation. This tells you how much the fund's returns vary from its average return. A high standard deviation means the fund's returns are more volatile. For example, if Fund A has a standard deviation of 10% and Fund B is at 4%, Fund A's performance is more unpredictable. It may have had great years, but also some rocky ones. If you're a conservative investor, this matters. Next, there's beta. Beta compares the fund's volatility to the overall market. A beta of 1 means the fund moves in sync with the market. A beta greater than 1 means the fund is more volatile. It might outperform in bull markets, but fall harder during downturns. A beta less than 1 implies less volatility. It may offer more stability, though possibly with lower gains. Another key metric is the Sharpe ratio. It tells you how much return the fund is generating for each unit of risk. A higher Sharpe ratio is better. It means you're getting more bang for your risk buck. If two funds have the same return, but one has a higher Sharpe ratio, it's the more efficient option. Risk is not always bad, but understanding it helps you align your investments with your comfort level and goals. Fact sheets lay out these numbers for a reason, so you can decode whether the fund's journey to returns was a smooth ride or a roller coaster. What's actually inside the mutual fund you're investing in? This section of the fact sheet tells you exactly where your money is going. Look at the top holdings. These are usually the largest companies or bonds the fund has invested in. For equity funds, this could be companies like Apple, Microsoft, or Tesla. If you're investing in a fund that claims to be diversified, but 40% is in just 2 or 3 tech stocks, that's something to be cautious about. Then, check the sector allocation. Does the fund invest heavily in technology, healthcare, or energy? Sector concentration can make your portfolio more vulnerable to downturns in specific industries. A tech-heavy fund might do well when innovation thrives, but it can drop hard during regulatory crackdowns or market corrections. Another important element is market cap exposure. Is the fund investing in large cap, mid cap, or small cap companies? Large cap firms offer stability, while small cap stocks might deliver higher returns, but also more risk. A balanced fund will usually spread investments across all three. For bond funds or balanced funds, examine credit ratings and duration. This tells you whether the fund is investing in government bonds, corporate bonds, or high-yield instruments, and whether they're short-term or long-term. Longer durations often mean more interest rate sensitivity. Understanding the portfolio composition gives you insight into how diversified and resilient your investment really is. Now let's talk about the human behind the machine, the fund manager. This person is responsible for selecting the investments and executing the fund strategy, and their track record matters more than most people realize. Look at how long the fund manager has been managing this particular fund. If they've only been around for a year, historical performance may not reflect their skill. But if the same manager has been behind the wheel for 5 to 10 years, you can more confidently attribute the fund's performance to their decisions. Cautionary. Then check if the fund manager manages other funds as well. Some seasoned managers may be stretched thin overseeing multiple funds. This might affect performance, especially during volatile markets. Pay attention to the investment philosophy mentioned in the fact sheet. Is it a value-based strategy focused on undervalued companies, or a growth strategy that targets companies expected to expand rapidly? Some funds use a quantitative model, while others rely on fundamental research. Understanding the strategy helps you evaluate whether the fund aligns with your expectations. A well-managed fund with a consistent philosophy is more likely to withstand market turbulence. It's not just about numbers, it's about the judgment and consistency of the people managing your money.
Now let's talk about something that quietly eats into your returns: fees and expenses. Every mutual fund has a total expense ratio, or TER. This represents the percentage of your investment that goes toward covering the fund's costs, like management fees, marketing, and administrative expenses. For instance, if a fund has a TER of 1.2% and you invested $10,000, you're paying $120 per year in fees, whether the fund makes money or not. Some actively managed funds charge higher fees due to the involvement of a fund manager. Passive funds, like index funds, usually have much lower TERs, sometimes as low as 0.1%. Over time, these differences can massively impact your returns due to compounding. Then there's the exit load, or redemption fee. Some funds charge a small percentage if you withdraw your money before a specific time period, typically to discourage short-term investing. Always check the lock-in period and exit load to avoid surprises later. And beware of performance fees, if any. These are extra charges that apply when a fund exceeds a certain return benchmark. They sound reasonable in theory, but they can incentivize excessive risk-taking. Fees may seem small, but they add up and can significantly reduce your long-term wealth. A fund with a lower TER and strong historical performance is usually a better deal, all other things being equal. We're almost at the finish line. Now it's time to compare the fund's performance to its benchmark. This step helps you evaluate if the fund is really adding value.
Every fund is benchmarked against a specific index. For example, a large-cap U.S. equity fund might be benchmarked against the S&P 500. If the fund consistently underperforms its benchmark, especially over long periods like 3 or 5 years, it may not be worth the fees you're paying. On the other hand, a fund that regularly beats its benchmark, even by a small margin, might indicate smart management. Also take a final glance at the consistency of returns across different timeframes: 1 year, 3 years, 5 years, and since inception. Steady performance is usually a better sign than erratic highs and lows. Finally, ask yourself key questions. Does this fund align with my goals? Am I comfortable with the level of risk? Are the fees justifiable based on the performance? Is this fund complementing my existing portfolio or overlapping too much? When you can confidently answer these questions, using the fact sheet as your guide, you're no longer just investing blindly. You're making informed decisions. And that's how long-term financial success begins. If you found this video helpful, consider hitting subscribe. I make more content that helps you take control of your financial life, one smart decision at a time. Until next time, stay aware, stay prepared, and let your money work as hard as you do.